Hello friends, good morning to all of you. I hope you all guys are doing well. So if you remember guys, in the last two sessions we were talking about business combination Ind AS 103. Right, today is the third session on Ind AS 103. And I'm hoping guys you are gaining lots of understanding how to apply Ind AS 103 practically on the ground. Right, so let's continue with our session guys on Ind AS 103 business combination. Let's devote 5 to 10 minutes what we have done in the previous two classes. Right, so I prepare a small summary for you guys so that we can quickly learn and we can quickly recall what we have read in the previous two classes. Okay, so first what we discussed what is business combination, where the acquirer obtains the control over the acquiree or the business. That is a business combination. We are combining two or more business, right? We are combining two or more business in this case. It may be an acquisition of a legal subsidiary, it may be acquisition of multiple business, it may be acquisition of a one business, right? It may include merger, it may include amalgamation. We have talked about common control transaction as well. That means the transaction which has happened within the group. That means one subsidiary has been transferred from one subsidiary to another subsidiary. That means transaction between the fellow subsidiaries. Subsidiary gets merged into the holding company, holding gets merged into the subsidiary company. So any type of transaction in terms of transfer of business or legal entity within the group is called common control transaction, and it will get summarized in the definition of business combination. AS 14 we have talked about under Indian GAAP. It includes only merger and amalgamation. It does not talk about acquisition. It's only talk about merger and amalgamation. So the scope of AS 14 was very limited, and the scope of Ind AS 103 is very, very wide. Correct. Then we have talked about what is business. We said integrated set of activities to provide the output, to provide the goods and services, to generate the income, to generate the profit, to generate the investment income. That is what the business. In order to have a business, we said, first of all, business needs to be there. Business definition needs to be evaluated. If it is not a business, if the company which I am acquiring is not a business, I am outside the definition of a business, and then I am outside the scope of Ind AS 103. And then I need to check which other standard is applicable on that transaction. If there is no standard which is applicable on that transaction, then I need to apply generally accepted accounting principles. Correct. So very, very important to apply the definition of business to check and evaluate whether the definition of the business is getting satisfied in a particular transaction or not. We took the example of land, that we have purchased a company in which there is only a land. There is no process, there is no input, there is no output, right? In that case, it is not a business, it is an asset acquisition. So what we have read subsequently, that what are the different elements of the business? Input needs to be there, process needs to be there, which are capable of generating the output. It may possible that the output is generating on the transaction date. It may possible the output is not generated by the business on the transaction date, right? Then we have talked about substantive process, right? We have talked about the process needs to be substantive. If the output is generating, so the process and input is capable of continuing to generate the output. If the output is not generating, then the input and the process must be capable of generating the output, right? Skilled workforce we have talked about, which has the capable and skills, knowledge, experience to generate the output. Correct. Then we talked about asset acquisition. What is asset acquisition? Which is not a business combination. That means we are not acquiring a business, we are acquiring an asset. We have talked about the difference between the business and the asset acquisition as well, right? For example, in business, whenever we talk about business, one thing comes to our mind, that is goodwill, right? That is goodwill, right? Asset acquisition, we don't recognize goodwill. Business combination, we recognize goodwill. In business combination, we recognize all assets and liabilities acquired at their fair value. In asset acquisition, we are not supposed to require all the liabilities. It's only an asset, right? We capitalize only an asset, right? What about the deferred tax? We recognize deferred tax in business combination. We don't recognize deferred tax in case of asset acquisition. We talked about transaction cost. We capitalize transaction cost in case of asset acquisition, but transaction cost needs to be charged to P&L in case of business combination. In case of consolidated financial statement, and we said in case of standalone financial statement, it will get capitalized in the value of investment as per Ind AS 27. Right? Then we have talked about concentration test. What is concentration test? where the entire purchase consideration, where the entire gross asset is concentrated only a asset, only is concentrated only to an asset or a group of asset, then it is a case of concentration of asset. Then it is, if the concentration test is satisfied, then it is an asset acquisition and not a business combination. Right? Then we talked about what are the different methods of acquisition. First method, acquisition, and the second is common control transaction. What is acquisition method? It's a fair value method in which transaction happen outside the group. Common control method is a book value method in which the transaction happened within the group. Right? We have started with the acquisition method. We said there are the multiple steps involved in the acquisition method. What are those? First is identify the acquirer. Who is the acquirer? The acquirer is the person or the entity who has obtained the control over the business, over the investee. Then we said we need to identify the acquisition date. What is acquisition date? Effective date on which we have acquired the control. Right? If the effective date is not available easily, right, then we need to see when we have transferred the funds. We need to see when we have actually acquired the control on the assets and liabilities. That will be an effective date. Then we said we need to identify what is purchase consideration. Purchase consideration can be in the form of cash, in the form of assets, in the form of liabilities incurred. Purchase consideration can be in the form of equity shares transferred. Purchase consideration can be in the form of contingent consideration transfer. What is contingent? Which is dependent on the occurrence and the non-occurrence of future event. Purchase consideration can be the deferred consideration. Suppose I have incurred I have finalized a transaction or a deal at 100 crore rupees, and I'm saying out of 100 crore rupees, 50 crores I will pay after 2 years down the line. Right? So I need to do the discounting. All these things needs to be recognized at fair value. Correct? Basic principle of financial instruments in all the standards on the transaction date, all assets and liabilities needs to be recognized at fair value, subject to any exemptions which is given under Ind AS 101. Then we talked about transaction cost. In standalone, it will capitalize in the value of investment. In a console, it will get charged off in the P&L. Right? These are the other steps which we need to discuss today: assets and liabilities recognition, intangibles recognition, goodwill recognition, deferred tax recognition. Right, guys? So this is all things what we have already discussed. This is just the summary and the gist what we have discussed, so that you guys gain an understanding where we are and what we have already done. Right? If you see, guys, in the last 8 minutes, we have recapped what we have done in the previous 2 sessions. Correct, guys? So let's start with our class with the new topics. In the last class, we have closed our session on transaction cost. Right? So let's do a couple of questions on the transaction cost. Then we will move forward. Any doubt? Please let me know if you guys have any doubt. Tanushri has raised one point. She's saying good morning. Good morning, Tanushri. Okay, guys, let's start. Transaction cost. Transaction cost, right? What we said in the last class, it is an incremental cost. Incremental cost, right? It will be charged to P&L in the CFS. Charged to P&L, and in the SFS, it will be capitalized. In the value of investments. Correct? What are the examples of transaction costs? Recall Ind AS 109. Transaction cost. Jay has raised one point. If business acquired, then there will be no investment. Okay, very good question, Jay. Let me complete this, then I will answer to you. Transaction cost like stamp duty cost. Stamp duty cost. B. Legal cost. Registration charges. D. Brokerage. commission. Right, these are some examples and etc. as well. Right, okay, Jay has raised one point. If business is acquired, then there will be no investment. Okay, very good. How? Let's understand. Whose query is this? Jay query. Right, let me take an example. Jay, correct. B has A limited, B limited. Right, B has multiple subsidiary, 100% like C limited, D limited, and E limited. Right, all these are the wholly owned subsidiary. Right, and A has acquired in this transaction. Sorry, A has acquired in this transaction. Right, A has acquired C limited at a purchase consideration of 100 crores. Net asset at fair value of this company is 80 crores. Right, and the net asset of this company at book value is, let's say, 60 crores. Right, now A limited. I hope the query must be clear, the transaction must be clear. A is acquiring C limited, which is legal entity, right, which is a legal entity. Right, so let's say this is A limited balance sheet, which is the standalone financial statement. In the standalone, A will recognize investment. What is the entry? What is the entry? Investment account, investment in C limited, and A has acquired 100% control. Right, A investment C limited account debit to bank 100 crores. Right, so A limited will recognize 100 crores in its books of accounts. Correct. Similarly, bank will get credited. Correct. This will be the standalone accounting relevant extract. Correct. Relevant extract. Correct. Now come to the console books. Now come to the A limited CFS. Right, or let me add one more complexity. Let me take transaction cost is equal to 10 crores. Right, transaction cost is equal to 10 crores. So what will be the entry here? This will not be 100 crores. This will become 110 crores, and this will be 110 crores, and this will be 110 crores outflow. Correct. Now come to CFS. What is the accounting entry? First, we need to compute goodwill. Compute goodwill. What is the formula of computation of the goodwill? Purchase consideration 100 crores minus net asset acquired at fair value, which is 80 crores. Correct. This 20 crore rupees will be recognized as goodwill. Correct. This 20 crore rupees will be recognized as goodwill. Correct. And this transaction cost of 10 crore rupees, which is included here, that will be charged to P&L. So what is the first entry? First entry in the console will be net asset at fair value account debit of rupees 80 crores. Goodwill account debit at 20 crores to purchase consideration 100 crores. Right, let's say this purchase consideration is to be discharged in cash or bank. Right, this has already been done. Basically, this purchase consideration has already been done because the entry has already been passed in the standalone books here. This bank account has already been passed here. Correct. Okay, second entry will be the transaction cost which we have recognized in the standalone financial in the account of investment, that will be charged to P&L. So what should I do? P&L debit transaction cost, account debit 10 crore rupees to investment in C Limited 10 crores. This will be the accounting, guys, which we need to pass. Are we clear, guys, that in the standalone, this in the acquisition of a legal entity, this will get capitalized in the value of investment, right? In the value of investment, transaction cost will get capitalized. Cost will be capitalized, right? And in console, we are applying business combination accounting. Business combination accounting. Okay, Sheena has raised one point. Sir, may you explain the part when the business combination accounting needs to be done in the CFS? This is what we are saying, Sheena, that business combination accounting, which is 103 accounting, we are applying in the console. What is business combination accounting? That we will compute goodwill. We will recognize assets and liabilities. So we are doing in CFS, right? In the standalone, we only say that I have acquired a control, I have purchased the investment, I have purchased the equity shares of C Limited. So this is my investments. Investment in C Limited. Ayush is saying, sir, example 4 is not clear. So Ayush, we will take up this example at the end today. Right, guys? I hope how to do the accounting of the transaction cost must be clear to you. Right? Let me give the heading of this transaction: acquisition of a legal subsidiary. Acquisition of legal entity. Right? Now let me take an example. I will change my example. Example 2. Now what is this example? A Limited. This is B Limited. Now in this case, B Limited has business. Business 1, business 2, business 3. Right? Business 1, business 2, this is the business. Right? Not separate legal entity. Okay, Sairam has raised one question. Sir, in CFS, why you have not taken the transaction bank account while passing the transaction cost? Very good question. Very good question. Why we have not taken, why we have reversed the investment? Because the entry has already been passed through bank. Transaction cost debit has been capitalized and bank has already been credited here. मैं दो बार पे करूंगा क्या थर्ड पार्टी को 10 crore rupees? There is only one company. There is only one company, A Limited, who has paid the transaction cost of 10 crore rupees. Right? There should be an outflow of 10 crore rupees only in the books of the company, right? Which we have considered here. And when we have passed this accounting entry, this standalone books will flow to the console. How should I prepare the console? Standalone balance sheet. How I prepare the console financial, guys? Let's understand. SFS of holding plus SFS of subsidiary plus and minus intercompany elimination is equal to console financial statement, right? When one entry has already been passed in the standalone financial of holding company, do I need to pay again in the console books because I'm preparing a CFS? Saram, I am asking you, I have passed an entry, I have paid 10 crore rupees in the standalone financial statement and I have recorded in the standalone, right? Which will flow to the console, because how the console financial is to be prepared: standalone financial of holding, standalone financial of subsidiary, and plus and minus intercompany elimination. Now just think about it. Do I need to pay this again or do I need to pass this accounting entry again in the console? No, this is already coming. This is already coming. Are we clear? Sairam, are we clear on this? Let me take a question again. Example 2 on the next page. I hope this is clear to you guys. Just think about it. How to prepare the consol financial statement. We are not supposed to pass any transaction again in the consol. वो तो standalone में already pass हो गई ना transaction. Right? फिर तो आपने जो assets purchase करी during the year उसको भी दोबारा entry pass कर दो in the consol. Then it results into a duplication effect. Right? So this is the holding company standalone. This is the subsidiary company standalone. This is intercompany elimination. Intercompany elimination, and then we will get consol books. Are we clear, guys? Yes or no? Sairam, I'm waiting the answer from you at least, since you have raised the question. Okay, meanwhile, let's move on. So there will be no bank, right? This has already been paid in the standalone. Bank has already been passed. It's only a purchase consideration. Okay, let's take an example. A Limited acquired B Limited, right? This is business B1, B2, B3, correct? Now all these are business, not separate legal entity, right? Now I am talking about it's a case of merger. A is purchasing B1 and merge it in A Limited. It's a case of merger, right? What we are saying, A Limited has purchased B1 business and merged in its company, correct? Purchase consideration paid 100 crores. Net asset acquired at fair value 80 crores, correct? 80 crores. Correct. This is a case of merger. So this is acquiring B Limited, and B Limited is B business, and this is getting merged in A Limited. Now what is happening, right? That means here we have only standalone financial statement, no consol financial statement, correct? So in the standalone financial statement, since this is a merger, we need to apply business combination accounting, right? Why? Because it is a case of merger. My trial balance and the B business trial balance will get merged into a single trial balance, right? So what I need to do, I need to compute goodwill, right? Purchase consideration 100 crores minus net asset 80 crores at fair value is equal to my goodwill, correct? Entry will be in the standalone, and let's say transaction cost, let's add transaction cost of 10 crores, right? So what is my first entry? First entry will be net assets I have acquired at fair value 80 crores, goodwill debit 20 crores to purchase consideration or bank 100 crores, correct? Second entry will be P&L debit transaction cost of 10 crores to bank. Right, guys? That means in the case of merger where no legal entity is going to set up, then we need to pass the business combination accounting in the standalone books. In the first class, I said business combination is the consolidation concept, but only in the case of merger and amalgamation, this accounting needs to be done in the standalone books. Okay, Ayush is saying if we are not acquiring a legal entity, then what's the logic of recognizing goodwill? Synergies. We are getting the synergies, we are getting the business brand, we are getting the value of the business. Why I am acquiring if there is no benefits, if there is no synergies in the future? I have acquired a business, that's why I am recognizing a goodwill. Right? It's not a case that if it's not a legal entity, it's not a concept. Agar legal entity nahi hai, to goodwill nahi hogi, it's not a case. Right? It's not a concept. The concept is we are saying if we are acquiring a business, right, it will be a business combination accounting. Correct? Am I clear, guys? Am I clear? Yes or no? I hope the concept of business combination in case of acquisition of legal entity and the acquisition of and the merger or amalgamation must be clear to you. Okay, one person, Kumar Mangalam, has raised one question. Respected sir, in July 2021 examination, first question about the consolidated financial statements, which have two consolidation dates. As the combination of three companies in this. Should we consider the period wise amount or take the simple consolidation amount? Okay. So business combination, let's say, I think Kumar Mangalam, what you're talking about, multiple acquisition in a year. Multiple acquisition in a year. Right? Let's say this is the year 1st April 2021 and this is 31st March 2022. Right? Let's say this is 30th June. Let's say this is 30th September and let's say this is 31st December. Right? Correct? Here we are saying acquisition of A Limited. Here we are saying acquisition, this is a case of X Limited, correct? X Limited is acquiring A Limited, purchase consideration 100 crores, net asset acquired 60 crores. This is my goodwill 40 crores. This is, let's say, acquisition of B Limited and this is acquisition of C Limited, correct? Now in this case, purchase consideration is, let's say, 150 crores. Net asset acquired is equal to 100 crores, right? So my goodwill is 50 crores. And in this case, let's say purchase consideration is 50 crores. Net asset at fair value is, let's say, 60 crores. Then it will be a case of bargain purchase gain. Correct, my dear friend? Now in this case, what is going to be happen? I need to apply business combination accounting on this date. Apply business combination accounting on this date, right? On this particular date, apply business combination accounting for another acquisition. On this particular date, I will apply business combination accounting on this particular date, right? That means business combination accounting needs to be done on acquisition date. Acquisition date, transaction by transaction. Transaction by transaction. Right? It will not be a case that for entire business combination which has been done in 1 year, I am doing the accounting as on 31st March 22. That will not be a case. The accounting of this needs to be done on this date. Accounting needs to be done on this date. Accounting needs to be done on this date. Are we clear, Mr. Manglam? Are we clear, guys? I believe you are asking, this what the question you are asking, that multiple acquisition in a one particular year, should I apply the business combination accounting after combining all those things, or we will apply the business combination accounting on the respective dates? Are we clear, guys? Yes or no? One person has raised a question. Ayush is saying, sir, but the console only prepare at the year end. You are absolutely correct. Console we will prepare at the year end. Now, guys, let me clarify. Let's say X Limited is a listed company. X Limited is a listed company. Now, guys, tell me, as per the SEBI reporting, we need to prepare the console as of 31st June, 30th June. We need to prepare the console financial statement 30th September. We need to prepare the console financial statement 31st December. We need to prepare the console financial statement as on 31st March 2022. Should I wait for all these acquisition accounting as at year end, or should I keep on doing the accounting on the respective date because I'm supposed to prepare console financial statement? Ayush, are we clear? It is not the case console financial statement is to be prepared as at year end. It is always at the period end, reporting period, right? This is one period, this is another period, this is another period, and this is another period, and the entire year is also another period. Ayush, are we clear? Are we clear, Ayush? Okay, Jay has raised one point: when no separate legal entity, then expense transaction cost instead of capitalizing. Okay, when there is no separate legal entity has been acquired, we are charging this transaction cost in the P&L, right? Why? Because for group, transaction cost is an expense, right? But in the standalone, it is a cost. In standalone, this is a cost. Transaction cost is a incremental cost. Incremental cost, right? And hence capitalized. Right? I think Jay is getting confused why this will get capitalized in the standalone. Let me give you a small example of the cost. Jay, you have to revert me on this answer, on this question. Correct? Let's say this is J Limited, right? This is A Limited. Correct? Now, Jay, you have purchased plant and machinery from A Limited at a cost of 100 crores. Correct? Now, you have incurred additional cost. Additional cost. What is the additional cost? Installation cost, 10 crores. Freight cost. Freight in the sense from the premises of A Limited to the premises of J Limited. That is a freight cost. 20 crore rupees. Right? There are certain taxes which you are paying. Let's say 5 crore rupees. Now, Jay, tell me at what value I will capitalize my plant and machinery. Question is, at what value J Limited will capitalize plant and machinery. Jay, I am waiting for your response. Meanwhile, I am taking the other queries. Ayush has raised one point. Clear, sir? Acquisition accounting is done only in the standalone financial statement. Hence, we record the same on the date of acquisition. But console, we are preparing on reporting period end. Not clear, Ayush, what you're saying. What I have said is acquisition accounting or business combination accounting needs to be done in the console financial statement. First of all, right? Only in case of merger and amalgamation, business combination accounting needs to be done in the standalone books. Simple. Right? Since I'm acquiring a legal entity and I'm taking that entity as a separate legal entity, I will prepare the console book. So it might console accounting, right? Let me write this again. I have written in the first session, right? But I'm not sure why the people are getting confused. Business combination accounting needs to be done in the consolidated financial statement. Correct? Right? Then we are saying, however, only in case of merger and amalgamation. In case of acquisition, business combination accounting needs to be done in standalone financial statement. Simple concepts. Business combination accounting, or we can say acquisition accounting. Guys, please read this again. Business combination accounting needs to be done in the console books. अगर हम console में कर रहे हैं तो transaction cost console में P&L में जाएगी. We will recognize goodwill in the console. If we are passing the accounting entries in the standalone books, in case of merger and demerger, then transaction cost will be charged to P&L in the standalone. Goodwill needs to be recognized in the standalone. Correct? Very simple. I have summarized everything in a very simple language, guys. Right? I hope then it will not create a problem going forward. Okay, Jay has reverted 130 crores. What the Jay is saying? So he's saying that this is assuming this purchase cost is after that. Okay. Already included. Let's say assume already included in 100 crores. Reasonable assumption he has taken. Very good answer. right? So what we are saying, cost is purchase cost. Purchase cost is 100 crores, right? Then we have installation cost. Installation cost, which is this 10 crores. Then we are saying freight cost of 20 crores. Correct? This is my total cost. Now, Jay, just tell me one more thing. I'm adding one more point here. If I paid brokerage, of 10 crores, right? Jay Limited has paid brokerage of 10 crore rupees. What should I do? Should I charge this brokerage in the P&L, or should I capitalize this brokerage in the value of 130 crores? What should I do? I'm waiting for your response, Jay. Now Jay is saying capitalized. Brokerage plus 10 crores. So my total cost will be 140 crores. Right? Now, guys, can I say this cost is directly attributable cost? This cost is also directly attributable cost. Right? What is directly attributable? Nothing but a transaction cost. In the PPE, you are giving me an answer that this will get capitalized. This brokerage cost will get capitalized. This installation cost will get capitalized. With this freight cost will get capitalized. Right? Now just say I take another example. Right? What is the example? J Limited purchases, right? Or J Limited invested 100 crores in shares of Reliance Limited, right? And J Limited has incurred a transaction cost, or I should say brokerage cost of rupees 10 crores. Now, Jay, tell me what is the accounting entry which you are passing here? What is the accounting entry you will pass in this example? First entry, you will say, I have made an investment. What is my purchase price? 100 crores. Plus, I have paid brokerage as well. I have paid brokerage as well of rupees 10 crores. So my net cost will be 110 crores. So you will say investment in Reliance, debit 110 crores to bank. Correct, Jay? Right? So what you have done, you have capitalized brokerage cost, transaction cost in the value of investments. Correct? This is what the standard is saying. When you are preparing the standalone financial statement, this brokerage, this transaction will be capitalized in the value of investment. I hope things must be clear to you now. I hope everybody has got the concept why we are capitalizing brokerage cost. Just take the transaction on you and think about it. Try to visualize this transaction. If you have paid 100 crore rupees to purchase the shares of Reliance, Bharti Airtel, or any other company, and you have paid brokerage commission, so will you charge that brokerage or commission P&L? You will say, I have incurred 110 crores to acquire the investment in shares of Reliance. My investment will be 110 crores, right? So when you are doing the normal principal accounting in your books of accounts in the real life, why the accounting should get changed when we are talking about a company? Accounting remains same, guys. In your case, it will be capitalized. In the case of the company under 103, it will be capitalized. Under Ind AS 109, amortized cost, we said it will be capitalized. In case of FVTOCI, we said it will be capitalized, but only in case of FVTPL, we said that it will be charged to P&L, right? Personal life, Ind AS 103, Ind AS 109, all are aligned in terms of transaction cost accounting. Are we clear? Are we clear? Yes or no, guys? I need the answer from everyone. Are we clear? Yes or no? Otherwise, I will not be able to move forward. I've given you enough example, multiple questions, multiple. Try to explain in a multiple scenario. Personal life 103 linked with Ind AS 109. I need the answer from everyone. Are we clear? Yes or no? So that I can move ahead. Okay, Ayush is saying if the brokerage incurred irrespective of the fact whether acquisition going to take place or not, then it is not a business. First of all, I will not be able to account for a business combination accounting. Then it will be a cost to P&L. It is not a transaction cost, right? What is the definition of transaction cost? If the business has not been, if the transaction has not been happened, the transaction cost would not have been incurred. अगर acquisition ही नहीं होती तो transaction cost भी नहीं होती. That is called transaction cost or the incremental cost, right? अगर मैंने brokerage और commission incur कर दिया है without knowing that whether I will get the business or not, then it is not an incremental cost. It will not be capitalized. It will be directly charged to P&L in all scenario. Right, Ayush? Okay, guys, let's move on. I hope things must be clear to you guys from all 360-degree perspective. I have linked everything. Aditya is saying, yes, sir, we are clear. Sairam is saying, yes, sir, we are clear. Thank you, guys. Let's move on. Let's do a couple of questions. Illustration number 13. Page number, what is the page number? 13.35. Let's do quickly, guys. We have devoted in resolving all your queries around 45 minutes, but no worries. That is very, very important. All the queries needs to be resolved. Only then the person can understand on the subsequent concept. Otherwise, we stuck on its queries. Okay. Question number 13. Should the stamp duty paid on the acquisition of the land? Ab land acquire kar rahe hain and we are paying stamp duty. Pursuant to a business combination, be capitalized to the cost of asset, or it should be treated as an acquisition related cost and accordingly be expensed off, right? What is the question, guys? Very important question. It is an interplay. It is an interlinkage between how many standard? Interlinkage or interplay between two standard, Ind AS 103 and Ind AS 16. Ind AS 16 क्या कहता है? Ind AS 16 is saying that transaction cost will be capitalized. Transaction cost will be capitalized in the value of asset, right? Ind AS 103 क्या बोल रहा है? Ind AS 103 saying on the transaction cost that transaction cost shall be charged to P&L, right? Shall be charged to P&L. Ind AS 27 is saying transaction cost will be capitalized. Correct? Now in this question, let me frame a case study for you guys. Let's say A Limited acquires acquires C Limited, and this is D Limited. This is 100% subsidiary, 100% subsidiary, legal entity. Legal entity, right? So A Limited acquired C Limited at 100 crores, right? Net asset, C is having a net asset 80 crores at fair value, right? This net asset includes land as well. Let's say 10 crores. Include land as well. Now that when the business has been transferred, when this C Limited has been transferred to A Limited, right? This net assets will be transferred to A Limited. Now this land will also be transferred to A Limited, right? In order to transfer in its own name, A Limited incurred certain cost. A Limited incurred certain cost, maybe let's say like stamp duty cost. Stamp duty cost of 10 crores on transfer of land. Now the question is, what is the accounting treatment? What is the accounting treatment of transaction costs? I hope guys, case study must be clear to you. With the illustration number 3, I have built up a case study for you guys so that you can understand the question. Question is saying, agar hum India 16 apply karte, if I would have purchased the asset, I will capitalize that transaction cost in the value of asset. Now, since I'm acquiring a business, and in that business there is a land, on the transfer of the land I need to incur a cost, registration charges, legal fee, stamp duty cost, or any other cost. Now, what I need to do, should I apply India 16 and capitalize that cost, or should I apply 103 and charge directly to P&L in the console books? Tell me what should be the answer, guys, in this case. We have discussed the concept. Concept is there. I have already explained you the concept. This is the query in front of the chartered accountants. Now you guys have to tell me what is the accounting treatment you have to tell to your clients in this case. We'll be waiting for your answer, guys. Quickly, guys, quickly. Awaiting your response, guys, on this aspect. I think people are not responding. I'm not sure why. Yes, Ayush has said in the standalone capitalized, in the standalone it will get capitalized, and console it will be charged to P&L. Jay Srivastav is saying in the standalone capitalized, CFS reverse investment and charge to P&L. And Aditya is saying transfer to P&L. Absolutely, guys, you are absolutely correct. Bang on. Bang on. What we have to apply in this case, apply, since we are acquiring a business, apply Ind AS 103 accounting. We are not doing asset acquisition. Since we are acquiring business, right? This is not a case of asset acquisition. This is not a case of asset acquisition, and hence Ind AS 10, Ind AS 16 is not applicable. Right? So what is the accounting which I need to do? Right? Standalone books, capitalized in the value of investment, and in CFS, charged to P&L. Correct? Okay, Sairam is saying gross assets percentage method. If the gross asset exceeds the 90%, not only exceeds 90% or more, and it is a very subjective. It is very subjective, right? It depends upon case to case because 90% has not been defined. It is standard is only saying substantive, right? Substantive, that is not defined. Right, but practically we take 90% or more. It does not mean 89%. I will not say that it is not an asset acquisition or it's an asset acquisition. It depends upon case to case, but on practical ground we generally take 90% or more. If you have the same answer, you need to justify both the perspective of this point. Correct, Sairam? I believe I am very clear on this particular aspect. Okay, let's do another quick question. Question number 14. Let's move forward very quickly, guys. We have devoted significant time on understanding the concepts and resolving all the queries. Okay, question number 14, page 3136. ABC Limited acquired PQR. ABC Limited acquired PQR Limited. Okay, on 30th June. This transaction happens on 30th June 2001. The assets acquired from PQR include an intangible. So यहाँ से जो यहाँ पर assets आई, that includes an intangible as well. Intangible that comprises a wireless spectrum license. Intangible, what is the name? License. Correct. For this intangible, ABC Limited is required to make an additional one-time payment to the regulator. So now ABC Limited is required to pay to regulator. Right? TRAI is the regulator. Telecom Regulation Authority of India. Right? In the PQS jurisdiction in order to the right transfer. Why it is paying? To transfer the rights. To transfer rights. This is similar to land. A से B के पास land जा रही है. So I need to transfer the, I need to pay the legal charges. I need to pay the stamp duty charges. Right? Similarly, ABC Limited has to pay the transaction cost to transfer the right in its own name. In its own name. Right? Whether such additional payment to a regulator is an acquisition related cost. So this is a case of business combination. Correct? It is written in the question. Acquires PQR. Right? Acquires PQR. So I think it's not written in the question. It only says acquires. Right? So how should I frame my answer? We don't know whether it's a business or not. So what we should say, first point, if it is a business, if PQR Limited is a business, correct? In the standalone books, capitalized in value of investment, right? In the CFS, it will be charged to P&L, right? But if PQR is not a business, because question is not asking to evaluate whether it's a business or not, then we will say transaction cost will be capitalized in the value of intangible. correct? In this case, we are applying as per Ind AS 38, and here we are applying Ind AS 103. Correct, guys? Are we clear? Yes or no, guys? Are we clear, guys? Yes or no? I'm not getting the revert from the people. Okay, Ayush is saying, sir, please take the example 4. Ayush, we will take up in this example at the end. Let's continue with our concept which we are going on in the running. Right, okay. So what we have discussed, guys, we have discussed acquiry, this step, we have discussed acquisition date, we have discussed purchase consideration, we have discussed the transaction cost. Now we need to discuss step number 4, recognize all assets and liabilities assumed. Correct? Very comprehensive step. Step number 4. Step 4. Recognition of assets acquired and liabilities assumed. Right? Okay, so what we are saying in this case, in case of business combination, right? I'm using the word BC in case of business combination. Okay? In case of business combination, this stands for business combination. Right? In case of business combination, acquirer shall recognize all assets acquired and liability assumed at fair value. Liability assumed at fair value. Are you saying this India seems like a India's 115 on the footprints of 5-step model? Absolutely, absolutely, because this is, or I would say this is practically, this is how needs to be done in this scenario. Practically, we apply these methods only, right? And these are the logical methods due to which it has given a shape in the form of standard, right? So what we are saying is how to compute goodwill. In this case, goodwill computation, right? Whenever you guys talk about business combination, one thing comes to our mind, goodwill, right? Purchase consideration minus net assets acquired, right? Net asset means assets minus liabilities. right? Net assets minus liabilities. Goodwill will be the balancing figure or bargain purchase gain, correct? And this amount, this net assets needs to be fair valued on acquisition date. Needs to be fair valued on acquisition date, correct? So simple sense में हम क्या बोल रहे हैं? We are saying when we are doing the business combination accounting, when I am acquiring a business, when I am acquiring a legal entity, right? I need to account for net assets acquired. It may be land, it may be building, it may be plant and machinery, it may be intangibles, it may be etc. Right? Examples. What are the examples? This is 2, this is 3. Examples of assets acquired. What can be the examples? Land, building, computers, furnitures, vehicles, plant and machinery, correct, etc. Office equipment, correct, etc. What can be the liabilities? For example, trade receivable, other current assets, other current or non-current assets, right? Basically, entire balance sheet of the other party. Fourth, examples of liabilities incurred. Examples of liability assumed. For assets, we are using the word acquired, and for liability, we are using the word assumed. Okay, Ayush is saying, sir, goodwill which we are recognizing, is it to be amortized? If yes, then what is the period? Ayush, if you see, if I go back at the very beginning, right, we are here, and where goodwill? It's a 6th step, right? When we will be discussing about goodwill, only then I will be talking about amortization or impairment, right? So let's have patience. Let's go step by step, right? What are the examples? Now you guys have to tell me, guys, participate in the discussion. What are the different types of liabilities which the acquirer can acquire? Which the acquirer can acquire in the business combination? Tell me. What can be the examples? Trade payable, loans, long term, loans, short term, employee benefit related liability, right? Provisions, right? Provisions, other payables, right? So these are the different liabilities which generally the acquirer acquires in a business combination, right? All these things needs to be recognized. All such liabilities needs to be recognized at fair value, right? All these assets needs to be recognized Recognize at fair value. Are we clear, guys? Right? Purchase consideration, business combination, the acquirer shall acquire all the assets acquired and liability assumed at fair value. Computation, this is the way of goodwill computation. I will keep on increasing this formula going forward, guys. In the previous session, we have explained, we have divided the PC into multiple format, multiple items. Similarly, net assets. Okay, one person is saying, Shimona, she has raised the question for the first time. She is saying, can debenture will be assumed? Very good. Why not? Debenture, bonds, correct? One person is saying DTL, defer tax, correct? Okay, let's move on. Fifth, exception to the principle of fair valuation of certain transactions. Right? What is the heading? Exception. That means if we are saying A, in the exception we will say B. If in the principle we are saying yes, in the exception we are saying no. Correct? Exception to the principle of fair valuation. We said asset and liabilities needs to be fair valued. What is fair value meaning? Assets and liabilities needs to be fair valued. So what is the exception? In the principle we are saying assets and liabilities need to be fair valued. What is the exception? That assets and liabilities is not supposed to be fair valued. Right? What is the exception? Certain assets and liabilities needs to be recognized. Right? There may be certain exceptions as well. Okay. Now let's talk about exceptions. First exception is recognition of contingent liability. Recognition of contingent liability, right? What is the transaction? Let's understand a transaction. Try to understand the concept by way of an examples and the concepts. Only then you can retain for a longer time. Right? Let's say A Limited is acquiring B Limited, right? Acquiring B Limited. B Limited has contingent liability. Contingent liability of 100 crores. Correct? What is the example of contingent liability, guys? Quickly give me the examples of contingent liability. Income tax cases. Income tax cases pending. Pending GST cases. Third, suits filed by customers. Filed by vendors, right? So contingent liability as per Ind AS 27, right? Contingent liability is to be dealt by Ind AS 37, right? And it says disclose, right? So what is the principle? As per Ind AS 37, contingent liability needs to be disclosed. Needs to be disclosed and not recognized. in books of accounts. Correct? But in case of, as per Ind AS 103, contingent liability needs to be recognized. Needs to be recognized. Correct? So this is an exception. Exception means contingent liability. So in the books of B, it is not recognized. It must have been disclosed. Disclosed in notes to accounts. I hope guys you must have seen the notes to accounts, how it is to be prepared, right? And in a case of business combination, A will record contingent liability. A will record contingent liability in its books of accounts. Clear guys? This is called an exemption or exception of Ind AS 37. Ind AS 37 में होते तो हम recognize नहीं करते, but हम Ind AS 103 कर रहे हैं. We will recognize provided there is a probability of outflow of resources and can be measured reliably, right? So simple sense summary. What is the summary of this? Contingent liability. Ind AS 37 disclosed and not recognized, right? Ind AS 103 recognize at fair value in the books of acquirer. Correct guys, are we clear? Are we clear guys? Second one is employee benefits. Second exception is employee benefits. Examples. What are the examples of employees benefits? Quickly guys, can you give me an example of employee benefits? Provision for gratuity. Provision for leave encashment. Correct? Correct guys. Now what is the summary? Employee benefits. Ind AS 19 and Ind AS 103. In Ind AS 19, this will be accounted on the basis of actuarial method. Actuarial valuation method. What is the method? Method is project credit unit method. Project credit unit method. Right? Same concept will continue under 103. Such employee benefits needs to be accounted as per Ind AS 90. That means हम उसको fair value पे record नहीं कर रहे, we are recording as per Ind AS 19. Okay, Jay Srivastav is saying for contingent liabilities, 103 is a carve out of 37. It is not a carve out. It is not a carve out. Right? What is carve out? IFRS versus Ind AS is equal to carve out. Carve out or carve in. Right? When we are comparing a difference between two framework, that name is given as carve out. Right? We are using a word exception here. Standard has used the word exception here. Difference between Ind AS 37 versus 103. Right? We should use the word exception. Right? Here we should use the word carve out. Are we clear, guys? Yes or no? Okay, this is B. What is C? What is C? C is income tax. Income tax or deferred tax. Right? Which standard? Ind AS 12. Right? So we are saying as per Ind AS 103. Right? Or I would say as per Ind AS 12. Ind AS 12, no deferred tax is recognized. No deferred tax is recognized on acquisition or purchase of assets and liabilities. Right? But Ind AS 103, deferred tax needs to be recognized on the difference between fair value or book value of assets acquired. Right? Fair value or the book value of the assets acquired. Right? So what is the summary here? Deferred tax. Ind AS 12. No deferred tax on purchase of assets and liabilities. Ind AS 103. Deferred tax to be recognized. Deferred tax to be recognized. How this deferred tax to be recognized? What we need to do? Let me take next sheet. Method of computation of deferred tax. Assets right? Here assets like fixed assets, building, trade receivable, etc. This is book value, this is fair value, this is the difference, right? This is the difference. Then we will multiply by this at tax rate. We will get deferred tax. Right? Similarly, liabilities, trade payable, debentures, bonds. Correct? This is how we will compute deferred tax asset or deferred tax liability. This will be net deferred tax. Accounting entry. Goodwill debit to deferred tax liability. Right, guys? Saram is saying, sir, please show the previous slides. This is the previous slides. Right? So this is about deferred tax, income tax. Then we have indemnification assets. Indemnification assets. What is indemnification assets? What is indemnification assets? Let's say A Limited and this is B Limited. A Limited is acquiring B Limited, right? And B Limited has 10 court cases lying outstanding, right? Outflow is expected to be, let's say, 10 court cases lying outstanding, 2 suits filed by vendors, right? And B Limited is disclosing this as contingent liability of, let's say, 10 crores. Right? So in business combination, as per Ind AS 27, this is a Ind AS 37, this is a disclosure. Right? Now in this transaction, B Limited indemnifies that B Limited will pay only to the extent of 8 crore rupees. Right? So that means when A is acquiring B Limited, A is mindful, A is concerned that it may possible in the future these court cases may result into an outflow of the amount. Right? So A Limited said B that boss, you need to indemnify me. You need to pay me if there is an outflow in the business on account of this aspect, these court cases. Right? So B Limited indemnifies that B indemnifies that B Limited will pay only to the extent of 8 crore rupees. B Limited can also say I will pay 10 crore rupees. B Limited can also say I will pay to the extent of 12 crore rupees. Right? In this case, as per 103 accounting, as per 103 accounting, A Limited will recognize contingent liability 10 crore rupees and indemnification assets 8 crore rupees in its books of accounts. In its books of accounts. Correct? So indemnification assets. So what is the principle? Indemnification assets. Let me write IA. Correct? Indemnification assets needs to be recognized on acquisition date at fair value. Right? Subsequently, what will happen subsequently? Subsequent accounting. Subsequent accounting. Such indemnification assets needs to be valued on collective basis, collectability basis. Any change in the value? Any change in the value shall be recognized in P&L. Right? So this is what the indemnification assets, where B Limited is of the view that there are certain contingent liabilities appearing in the books of accounts of the B Limited, which results into an outflow, right? And A Limited is acquiring. So A Limited is careful, A Limited is mindful that in future, if A Limited has to pay this liability, then it will result into an additional cost from A perspective. So B is indemnifying that I will be able to give you to the extent of 8 crore rupees. I will be able to give you to the extent of 10 crore rupees. I will be able to give you to the extent of 12 crore rupees. So this indemnification assets needs to be recognized along with the contingent liability. Right? These numbers can be same, these numbers can be different. Correct, guys? Okay, let's take quickly two example, which is question number 15 on indemnification assets. Question number 15, page number 13.42. Right, what is the question? ABC Limited acquired a beverage company PQR Limited. So ABC is acquiring PQR, correct, from XYZ Limited. From XYZ Limited, XYZ is holding PQR. Right, at the time of acquisition, PQR is defendant in the court case whereby certain customers of PQR have alleged that its product contain pesticides. So iska suit chal raha hai in the court of law. PQR is being sued for damages of 2 crores, correct? XYZ Limited has indemnified amount, indemnified for the losses if any due to the case up to 1 crores. Correct? The fair value of the contingent liability. So this has been disclosed as contingent liability. The fair value of this contingent liability is 70 lakh rupees. right? Fair value is 70 lakh rupees. How should ABC account for the contingent liability and indemnification assets, right? So scenario 1, A Limited will account for, A Limited will apply Ind AS 103. Correct? Contingent liability, record contingent liability amounting to 70 lakhs. 70 lakhs, which is fair value. Record indemnification asset to the extent of 1 crore. Right? This is up to 1 crore rupees. Right? When liability is 70 lakh rupees, indemnification asset will be recognized only to the extent of contingent liability, but he is indemnified to the extent of 1 crore rupees. So one side I am saying the contingent liability is 70 lakh rupees and I am recording intangible indemnification asset 1 crore rupees. Is it possible? It is not possible, right? So in that case, what we need to do, I need to recognize 70 lakh rupees as indemnification asset. One side I am saying मेरे को liability देनी है 70 लाख की और मैं asset record कर लूं 1 crore की. Not possible, right? Maximum up to 1 crore, right? But in the second scenario, read the second scenario as well. Read the second scenario, how ABC Limited should account for the contingent liability. What if the fair value of the liability is 1.2 crores? Fair value of contingent liability is 1.2 crores and indemnification asset is maximum 1 crores. So A Limited will record contingent liability 1.2 crores at fair value and indemnification asset maximum 1 crore rupees. Right? So this will be the negative number, this will be the positive number. Right? So I will record intangible only to the extent of indemnification asset only to the extent of contingent liability. Right? Or we can say indemnification asset will be the lower of contingent liability or the indemnified amount. Correct, guys? This is how this needs to be recorded. Let's do one more question, guys. Then we will take a break. Question number 16, page number 13.42. ABC Limited pays 50 crores to acquire PQR from XYZ. So this is ABC Limited. Right? This is XYZ Limited. This is PQR. Purchase consideration 50 crores. BQR Limited manufactured products containing fiberglass. So this is preparing fiberglass. Right? And has been named in the 10 cases. 10 case outstanding in the court. XYZ agrees to indemnify ABC for the adverse result. Adverse result for any court cases up to an amount. So indemnification assets up to 10 crores. The class actions have not been specified the amount of damages and the past experience suggests it may be up to 1 crore each cases. Right? Past experience is saying 1 crore each multiplied by 10 case. So 10 crore rupees. But they are often settled. For the small amount. ABC Limited makes an assessment for the court cases and decide that due to the potential variance in the outcome, contingent liability cannot be recognized. cannot be recognized. Contingent liability cannot be measured reliably. Cannot be measured. Cannot be measured reliably, and accordingly no amount is recognized in the court cases. So what we are saying in the concept, we said contingent liability will be recognized only if it can be measured. If I go back, we have mentioned if there is a probability of outflow of resources and it can be measured reliably. In this case, we are saying there is no contingent liability. Contingent liability is not to be recognized. Right? Why? As it cannot be measured. As it cannot be measured reliably. Right? And therefore, no indemnification assets to be recognized. This will be the accounting treatment, guys. If it is not measured, we will not be able to recognize contingent liability, and therefore we will not be able to recognize indemnification assets. I hope the things must be clear to you. Now let's take a break for 15 minutes. Let's come back after 15 minutes. Correct, guys? And let me know if you have any doubt on this. Let's take a break for 15 minutes. So Jay is asking, what is the meaning of collectibility? It is a realizable value. It means realizable value. Correct? Okay. This is which point number? Point number D. Then we have point number E. Reacquired rights. Reacquired rights. Reacquired right means right to use brand name under franchisee agreement. These are the examples. Under franchisee agreements. Right to use license. Right to use license under licensing agreement. Right? What is reacquired rights? Reacquired rights are those rights which were given to acquiree, before business combination. Before business combination. And by way of combination, acquirer is acquiring such rights. Acquiring such rights. Again, right? What is the accounting treatment? Such rights needs to be recognized as intangible. Such right needs to be recognized as intangible on acquisition date. Acquisition date. Right? And such intangible asset, such rights needs to be amortized over the remaining contractual period. Remaining contractual period. Third point is, if there is any gain or loss on settlement, it will be charged to P&L. Right? It will be charged to P&L. Similarly, this is point number E. Similarly, we have another exception, F. What is the exception? Exception in respect of assets assets held for sale, right, which is Ind AS 105, where in case of any business combination, any assets acquired is held for sale, then such assets shall be recognized. Such assets shall be recognized as per Ind AS 105, right? What is 105 is saying? As per 105, Ind AS 105, such assets shall be recognized at cost or fair value less cost to sell, and whichever is lower. Right? In case of the acquirer who is acquiring the asset held for acquiring any assets, and in that asset there is an asset which is held for sale, it will be recognized either at cost or fair value less cost to sell as per Ind AS 105. As per Ind AS 105. This is exception number F6, which is another exceptions. Share-based payment transaction. Share-based payment transaction. Guys, in this thing, only one thing is common. In all these items needs to be recognized as per their respective standard. Right? As per their respective standard. Share-based payment, what is the transaction in case of business combination? In case of business combination, acquirer may issue its ESOPs, share issue its ESOPs in place of acquiree's ESOPs, right? Such ESOPs shall be accounted as per Ind AS 102. Right? Such ESOPs needs to be accounted as per Ind AS 102. Correct, guys? Another exception. What is that? Lease transaction. Another exception is a lease transaction where acquiree is a lessee, right? Acquiree is a lessee. For example, A Limited, this is B Limited. A Limited is the acquirer. B Limited is the acquiree. Right? B Limited has taken assets on lease from C Limited, right? So B must be recognizing or doing Ind AS 116 accounting in its books of accounts what A Limited is required to do on the date of acquisition, right? So in this case, what we are saying, acquirer will recognize the lease liability as the present value of future liabilities, present value of future lease liability. Correct? ROU will, or acquirer will recognize ROU. Acquirer will recognize ROU with the same value as of lease liability. Correct? Acquirer will be able to take. Have you guys gone through Ind AS 116? Will be able to take low value exemption and short term exemption. Have you guys gone through Ind AS 116? Quickly guys, yes or no? Lease period is 12 months or less. What is low value? Small value items, small value leases. It depends on materiality limit. It depends on materiality limits. Correct guys. So what we are saying, if this is the transaction, then acquirer A will account for like this. Account for recognize lease liability as the present value of future lease liability. Account for ROU as the value of lease liability, and he will be able to take the exemption on account of short term and the long term basis. Right? I'm not getting any response, guys. Have we gone through Ind AS 116 or not? Okay. Now, second scenario would be where the lessee is lessor, is operating as lessor. In that case, what will happen? Value of receivables. Value of receivables will be recognized as same in case of acquirer books. Acquirer books. Priya is saying yes sir, we have done with Ind AS 116. So I hope guys you can understand what is ROU, what is lease liability. Right? Adjustments needs to be done on account of any favorable or unfavorable effects. Correct? So this will be the accounting guys in case of lease transaction where the lessee, where the acquirer is operating as a lease, as a lessee, or where the acquiree or where the acquiree is operating as a lessor. Right? Another would be, this will be the last. Another would be acquiring assembled workforce. Assembled workforce. What is assembled workforce? Assembled workforce is nothing. Acquiring skilled employees. Acquiring skilled employees having relevant skills, knowledge, and experience. Right? Employee benefits like gratuity, leave encashment, that will be recognized. Gratuity, leave encashment, needs to be recognized. Correct? No intangibles to be recognized. On account of assembled workforce. So this will be the accounting, guys. In business combination, in a nutshell, we were saying that all assets and liabilities needs to be recognized at fair value, right? So we have talked about around 7 or 8 items which are not recognized at fair value, that will be recognized at different value, right? Let's summarize everything what we have read in this aspect. Okay, we were discussing this step, recognition of all assets and liabilities assumed, right? So we are saying all assets and liability needs to be recognized at fair value. Goodwill, purchase consideration minus net asset acquired, and this net asset will be at fair value. Examples of the assets acquired, these are the example which we have talked about. These are the examples of liability which we have talked about. Right now we are saying all these assets and liability needs to be recognized at fair value, but there are certain items which will get recognized which were not earlier recognized. Right? What are those items? Contingent liability. So we will recognize contingent liability at fair value which were not recognized. Right? Which were not recognized earlier. Employee benefits, that will be recognized as per Ind AS 19 only. Income tax, we will recognize income tax or deferred tax on the difference between the assets and assets at book value and fair value. One person has raised a question, sir, why we are recognizing a deferred tax? Right? Because there is a difference between the book value and fair value. Right? You need to understand the concept of deferred tax. Deferred tax is always, deferred tax needs to be recognized in books to reconcile my statutory books and the tax books. To reconcile my statutory books and the tax books. I give you an example. I explain by way of an example, deferred tax concept. Right? Focus on this, guys. I am explaining the concept of Ind AS 12. Deferred tax concept. Right? This is a query raised by a person. Right? Let's say A Limited, right? A Limited has a PBT of rupees 1 lakh. Tax rate is 30%, right? This is books, right? And this is tax. How to compute tax? I will say this is my PBT, 1 lakh rupees. I will allow the provision for, I will disallow the provision for bonus, right? 20,000 rupees. I will disallow the provision for gratuity. Let's say 30,000 rupees. So my taxable income has reached to 1,50,000. Now I need to pay tax to the government authorities on this number, which is 1,50,000 at a rate of tax. Now the tax amount comes out to be 45,000 rupees, right? Multiply by this one is equal to 45,000 rupees. Right now, this tax amount will be recognized as income tax expense in my books of accounts, which is 45,000 rupees. Right? What is the PAT which is coming here? This is 60 and 55,000. Right? What is my tax rate? My tax rate is 30%. My tax rate is 30%. What is my profit? 1 lakh rupees. So ideally in books, my profit is 1 lakh rupees. My tax rate is 30%. My tax expense should be tax expense. Tax expense is 30,000 rupees. Right? But what is the amount which I am booking here? 45,000 rupees. Thereby, I will book a deferred tax income to the extent of 15,000 rupees, so that my net tax expense will reach out to be 30,000 rupees and my profit will reach out to 70,000 rupees. Right? So that means this tax rate and book profit will be 30%. This concept is called deferred tax concept. So what is the accounting entry which I have recognized of this deferred tax? Deferred tax asset debit 15,000 to deferred tax income in P&L 15,000. Right? So that means deferred tax is a concept to reconcile my book profit, my tax as per books, and my tax rate as per tax. Guys, are we clear with the deferred tax concept? This is the base of Ind AS 12. Guys, are we clear with the concept of deferred tax? Quickly, guys, are we clear with the concept of deferred tax? I'm not getting response. Okay, let me go back. So guys, we were recognizing deferred tax because of this reason, because the accounting profit and book profit will be changed on the acquisition of assets. Under books, I have recognized at fair value. Under tax, it will be recognized at book value. राइट सो जब ये टैक्स के अंदर बुक वैल्यू पर है और अंडर बुक्स में वो फेयर वैल्यू पर है, सो आई विल क्लेम मोर डेप्रिसिएशन इन द बुक्स, बट वो टैक्स में अलाउ नहीं होगा. दिस विल क्रिएट अ डिफरेंस एंड ऑन दैट डिफरेंस वी आर क्रिएटिंग डिफर्ड टैक्स. करेक्ट? Okay, let's move on. Indemnification asset. What is indemnification asset? Where there are certain court case which is lying in the books of accounts, which is going on, which is pending, right? So acquirer is asking to compensate if there is a liability come up in the future. So that amount is called indemnification asset, and indemnification asset cannot exceed the contingent liability. Correct? How it is need to be recognized subsequently? On the collective basis. What is collective basis? On the realization basis. Right? This is the example which we have taken, that in the scenario one, indemnification asset is more than the contingent liability, so will restrict to the extent of contingent liability. In the second scenario, contingent liability is more as compared to indemnification asset, so we will record full indemnification in this case. Right? Then we have talked about reacquired rights. For example, this is a case where the right has been given, where the contract has been given, contract has been entered before the acquisition date with the other party, right? For using the brand name, for using a license. Now, since I'm acquiring that company again, so those rights are coming back to me. So I need to book those rights as a intangible in my books of accounts, and that will be amortized over the remaining contractual period, right? And if there is any gain and loss on the settlement, it needs to be charged to P&L. Correct? Next is asset held for sale. If I'm acquiring a business and in which the acquiree is having an asset which is held for sale, so I need to recognize that asset at cost or fair value, whichever is lower. Right? Share-based payment transaction. So if I'm acquiring a business, it may possible the acquiree has already issued the ESOP scheme, ESOPs to its employees. Since I'm acquiring a business, I need to issue my own ESOP schemes. I need to reverse or cancel the acquiree's scheme. Then how it is to be accounted for? It is to be accounted for as per Ind AS 102. Right? Lease transaction, where the lessee is operating as a where the acquirer is operating as a lessee, then what we will need to do, we need to recognize lease liability at the present value of the future liability, and then we need to recognize ROU. The lessee, the acquirer can also apply the exemption, low value exemption and the short term exemption. Where the acquirer is a lessor, same amount will be recognized, same asset will come in the books of acquirer. Assembled workforce, we will not recognize. No intangible needs to be recognized. Only thing is we need to recognize provision for employee benefits, which we are recognizing separately. So guys, by this we have covered the step number, I think fourth step number, where we are talking about recognition of all assets and liabilities. Right? I will take you through on one page of study module 13.45, in which they have summarized this entire working in a single page. Just give me a moment. This I need in this 103. Yes, this one. 13.45, guys. If you come to 13.45, all this accounting has been explained in a single page. Very nicely explained. Yes, this one. Right? So we are saying this is an exception to the recognition and the measurement principle. Right? This is an exception to the measurement principle. Jay Srivastav is saying reacquired right is an intangible. Yes. So they have classified all these exemption into the various categories. First is recognition exemption. Right? What is that? Contingent liability. We recognize contingent liability under 103, but we don't recognize contingent liability under Ind AS 37. Then recognition and measurement principles both. Income tax, employee benefits, indemnification assets, and lease liability. So income tax recognized as per Ind AS 12, employee benefits recognized per Ind AS 19, indemnification recognized at fair value. Where the lessee is operating as a where the acquirer is operating as a lessee, in this case, recognize ROU, lease liability. Lease liability will be present value of the future liability. ROU will be the same amount as that of lease liability. Right? Certain measurement exceptions. Share-based payment recognized as per Ind AS 102. Asset held for sale recognized as per 105. Fair value less cost to sell or cost, whichever is lower. Reacquired rights recognized as intangible asset and amortize it over the remaining contractual period. So entire exceptions are covered only on this page itself, guys. Right? This is the gist of all exceptions. Right? Very nicely summarized in the study module. You should go through it and you can memorize this by this one particular page. Any doubt, guys? Any doubt? Let's move on, guys. So this is which step? Step number, I believe, 4. Step number 4. Now we need to discuss step number 5. Right? So we have covered till step number 4. Right, guys? Step number 5. Recognition and measurement of reacquired rights. Sorry, not reacquired rights, recognition measurement of intangibles. Right? On the date of acquisition, hidden intangibles needs to be identified and recognized. Such intangibles shall be recognized at fair value. Right? At fair value. Examples of hidden intangibles. Patent, trademark, right? Customer list, brand, trademark, customer list. For example, license to operate power plant. Right? Recognition of these intangibles. Recognition of these intangibles will reduce the value of goodwill. Right? Next point is how to recognize such intangible. Right? 2 criterias. One is contractual or legal. One is contractual or legal, or separability criteria. Or separability criteria. Right? So it just need to be satisfied in either of these two. What is contractual and legal? Such intangible asset means such intangible assets. So we are talking about intangible. IA. Such intangible asset needs to be recognized on the basis of contract or on the basis of legal approvals. Right? Examples: patent, trademark, license, brand, right? Franchisee agreement. Correct? So these are the contractual or the legal criteria. What is separable criteria? It means intangible asset is capable of being separated from the acquiree. Capable of being sold, transferred to third party. This is not arising out of the contract. For example, customer list. Customer list is non-contractual. Right, guys? This is the gist. What is the criteria in respect of recognition of intangibles? Right? This is the first is contractual or legal, and second one is separability criteria, and that how it needs to be recognized. Right? And once it will be recognized, right, then subsequent measurement accounting, subsequent accounting. What is the subsequent accounting? Estimate the useful life of intangible assets. Amortize such intangible asset over the useful life. This is the guidance, guys, on the intangibles. Right? Let's do one question. Only then I think we will be able to gain some more insights. Question number 17, page number 13.48. Company A, FMCG. So there is a company A and it is a FMCG company. Acquires an online e-commerce company E Limited acquires. So A Limited acquires E Limited with the intention to start its retail business. The e-commerce company. This is e-commerce. Right? The e-commerce company has over the period have 10 million registered users. So this company is having 10 million registered user. Correct? However, the e-commerce company E does not have any intention to sell the customer list. Should this customer list be recorded as an intangible? Right? So this is the customer list. Right? So what we are saying is A Limited is acquiring E Limited to continue its retail business, right? So as a part of the E Limited, as a part of this acquisition, he is also acquiring this 10 million registered user, which is called customers list. Now this registered users will become the customer of A Limited, which will increase its benefits of sale in the future. So as per Ind AS 103, such customer list shall be recognized as intangibles on acquisition date. Right, on acquisition date. Such customer list shall be recognized at fair value and will be amortized over its estimated useful life. Useful life. This will be the answer in this case. Okay, Kumar Mangalam has raised one question. So, respected sir, as per the accounting mismatch concept in Ind AS 109, is there any accounting mismatch in this standard with getting connect to the other standard, as many standards are linked to each other? If yes, then which standard gets upper hand on what basis? So very clear. First of all, there is no accounting mismatch in this case, right? What we are saying is we are not given the name of accounting mismatch. We have given the name of the this exception, right? And the standard has provided, first of all, there is no judgment involved. Standard itself has provided that if there is a required rights exist, you need to recognize at fair value. If the hidden intangible exists, you need to recognize at fair value. If there is an employee benefit exists, you need to recognize at Ind AS 19. If there is a ESOP, you need to recognize 102. Right? So there are different standards, because at the part of business combination, I am acquiring multiple assets or liabilities on which different standards are applicable. But how to account for standard of 103 itself providing the guidance only in case of business combination. If you are acquiring assets, if you are acquiring employee benefits, if you are acquiring intangibles, if you are acquiring patent, license, workforce, how to account for. So first of all, there is no dilemma, there is no confusion which standard needs to be applied, because it has been very clearly explained by the standard itself. I hope this is the answer to your question, Mr. Mangalam. Correct? Okay, let's take another question. Question number 18. Please read, guys. Question number 18, page 13.48. ABC Limited, a pharmaceutical group, acquires XYZ. So ABC Limited acquires XYZ Limited. Acquires XYZ Limited. Correct? Pharma company. This is pharma company. Jay Srivastava is saying, if I'm acquiring an asset which do not have an intention to sell, right? All assets and liabilities needs to be recognized at fair value. Okay, XYZ Limited has incurred a significant research cost. XYZ Limited incurred a significant research cost. Research cost in connection with the two drug. Okay, research cost incurred in connection with two drug. Drug 1 and drug 2, right, that have been undergoing clinical trials. Okay, out of the two drug, one drug has not been granted necessary regulatory approval, right? So in this case, no approval, no regulatory approval. Guys, it is very important why I'm preparing these kind of flowcharts of the facts, Because when you guys become a chartered accountant and go in the market doing the job, or you are doing any, you are will be working in the CA firm, right, as an auditor, as an employee, when such kind of transaction happens, or when you see those transaction, you need to understand the facts in a very detailed manner. If the facts are missing, you will not be able to reach at the correct accounting treatment, right? And practically speaking, I used to draw this diagram in the practical sense to understand how the transaction is flowing. If we are not clear with the transaction, we will not be able to provide the right advice to the client. So it's very, very important to prepare this chart so that we can understand the transaction, what's happening on the ground, right? So I'm actually preparing you guys in the future how to evaluate a transaction on the ground, correct? So please use these type of grounds, these type of flow charts to understand the transaction in detail. Okay, ABC Limited expect that approval will be given in next 2 years. So ABC here expects approval to be obtained in next 2 years, right? So we are of the view that the approval to aa jayegi, right? The other drug has been recently approved, so approval obtained, approval obtained, right? Drug revenue earning potential was one of the principal reason why ABC has acquired. So why ABC has acquired? Because he was able to see the potential in the business, that is, it will fetch a good market, right? That's why ABC has acquired this company. Whether research and development cost, whether this research and development cost on either of the drug be recognized as intangible in the books of ABC Limited, yes or no? So now the question is, regulatory approval has been obtained, right? It is a license, it is a right. In this case, it has been obtained, but in this case, it is estimated it will be obtained in next 2 years, right? So what will be the answer? Answer will be very clear. It will be recognized as intangible assets at fair value, right? This will also be an intangible at fair value, right? But probability of obtaining approval in future needs to be considered in determining fair value. Intangible at fair value, but probability of obtaining the approval in future needs to be considered because we have not received the approval today. So first of all, these needs to be recognized as intangible, no doubt. This will be at fair value. This will also be at fair value, but we need to consider the probability, whether 80% chance that we will get an approval, 90% chance, 60% chance. So the fair value will be adjusted subject to the future events. Any doubt, guys, in respect of business combination accounting on intangibles, hidden intangibles, acquisition of asset, or any other doubt in the past? Should we move on, guys? Okay, this is the step number what? This is step number 5th, right? I'm trying to explain you guys in a very simple and lucid manner. I hope you can understand, and by reading the notes, you can understand the concept. And I would request and suggest, after reading all these notes, you should also go through your study material. It is not the notes which I'm giving in the class. It is not a substitute of the study material. It is in the simple language you can understand, but I would request you to go through what is written in your study material, right? Okay. This is step number 6. Step 6. Recognize goodwill or bargain purchase gain. Now, can anyone tell me how the goodwill needs to be computed? How the goodwill needs to be computed? How goodwill needs to be computed, right? First of all, purchase consideration. Purchase consideration, right? In purchase consideration, we have cash, assets transferred, liability assumed, correct? Equity shares issued. C. One person is asking, Sairam is asking, research cost is also to be recognized as a intangible under Ind-AS 38. So research cost is not recognized as an intangible. Research cost is always to be charged in P&L, but development cost will be recognized as a intangible under Ind-AS 38. Contingent consideration. Correct? Contingent consideration. D. Deferred consideration. This will be the total. Total purchase consideration. Correct, guys? In the previous class, we have talked about this. Okay, Jay saying, sir, NCI भी तो record करेंगे. Yes, absolutely correct. We will also recognize NCI. I will explain after this. Recognize NCI, right? Then we will say this is the purchase consideration minus net assets acquired, which is at fair value, right? This will be at fair value. 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 So net asset acquired will be at fair value, right? Then what we will do, we will add non-controlling stake. Non-controlling stake, NCI, right? This will also be at fair value, correct? Then we will add fair value of previously held stake. Previously held stake, right? What is this? This is required in case of step acquisition, which we will discuss in next class. Step acquisition, right? What is step acquisition? Today I have acquired 40%. After 1 year down the line, after 2 years down the line, I am acquiring additional 50% stake. So my total percentage stake has reached to 90%. Total percentage stake has reached to 60%, more than 50%, right? That is the case of step acquisition. Then what we have said, then we will recognize contingent liability, right? We said that we will recognize contingent liability. At what value? Fair value. Then if we recognize contingent liability, and we need to check if the indemnification asset exists or not. Indemnification assets exist or not. We need to recognize that at fair value. Correct. Then we need to recognize intangibles. Right? We need to recognize intangibles. And thereby we will be reaching to goodwill or bargain purchase. Right? This intangibles, what are the examples which we have taken? This will be at fair value first of all. This will be at reacquired rights. Right? This will be patent, trademark, customer list, etc. Right? This will be the accounting of intangibles. And this is how the goodwill needs to be computed. And then on this goodwill, we need to compute deferred tax. Deferred tax, right? What will be the entry? Goodwill debit to TTL. Right? This will be an impact because of difference between book value and fair value of assets and liabilities acquired. So Jay Srivastav is asking, sir, if contingent liability recognized, then it becomes a liability due to business combination. Yes, it becomes a liability due to business combination. Absolutely correct. Any doubt, guys, in this? So this will become a comprehensive formula, or this becomes all the steps get covered in this one formula itself. Any doubt, guys? Any doubt? This will be like this. So let me also explain this. This is nothing but assets minus liabilities. I'm reducing net assets. Okay, guys, let's talk about NCI as well. What is NCI? Non-controlling stake. So Jay is asking why indemnification asset, etc. already part of purchase consideration A point above. So Jay, I have bifurcated here. All these assets and liabilities are those assets which I have acquired, and this is basically the consideration, how the consideration is discharged, right? For example, I have given a cash. I have acquired a business of 100 crore rupees. Now 100 crore rupees, 10 crore rupees I need to pay in cash, 20 crore rupees I need to transfer an asset, 30 crore rupees I need to assume a liability on behalf of the other company, and there is a contained consideration of 30 crores. This is a manner of discharging a purchase consideration. Discharge of purchase consideration. Discharge of PC. And this is the liability and asset acquired. Okay, Kumar Manglam is saying, respected sir, by calculation of the deferred tax, we indirectly also consider the difference between the book value and fair value. Hence, its effect also reflects. By calculation of deferred tax, we indirectly consider the difference between book value and fair value. Hence, it also affects and reflects. Absolutely correct. Absolutely correct. Absolutely correct. You are absolutely correct. Right? But the difference which we are recognizing only to the extent of tax. Only to the extent of tax rate. Correct? Because deferred tax we are computing to the extent of taxable profits or to the extent of tax rate. Okay, guys, non-controlling interest. Right? On acquisition date, right, acquirer has accounting policy choice. To recognize NCI either fair value or proportionate value. Right? This is acquisition date. Right? Fair value means fair value. What is proportionate value? That means fair value of net assets multiply by NCI percentage and multiply by the period. Right? This is how we will get NCI value. Right? What is net assets? Fair value of assets acquired minus fair value of liabilities assumed. Right? Multiply by the NCI and multiply by the period. This is how the NCI needs to be computed. Okay, Jay is asking, net asset acquired does not cover the indemnification asset. So net asset acquired here we are talking about exist in the books of exist in acquiree books. Correct? Here we are talking about does not exist. Does not exist in acquirees books. Are we clear now? Subsequent accounting will be proportionate accounting going forward. Right? Entry, if I need to look for entry, profits. So P&L debit to NCI in case of loss, NCI account debit to P&L. Correct, guys? Right. So what is the homework for the next class? I hope you have got the previous class notes. Recap all concepts. Try to understand concepts on logical manner. Right. Third, practice questions. Right. Thank you. Thank you, guys. We will meet in the next class. Right. So I hope you have gained lots of understanding. We have discussed the entire acquisition method. Within the acquisition method, couple of things: step acquisition, reverse acquisition, we will discuss in the next class, and we will also discuss common control transaction. Correct? Thank you so much for your patience. Thank you, Jay, for your support here. Thank you.